Welcome to This Explainer. Today, we are diving into the actual mechanics of money and banking to figure out how our economy really functions. I mean, we deal with money every single day, right? But here is a wild fact. The vast majority of the money you own doesn't actually exist in any physical form. No way, right? By the end of This Explainer, you are going to look at the cash in your wallet and those numbers in your banking app in a completely different way. Let's get into it. So just imagine the sheer physical exhaustion and honestly, the absurdity of trying to make this exact trade in a world without cash. Say you're a farmer. You've just harvested a massive crop of rice, but what you really need right now is a new pair of jeans. In a pure barter economy, you're literally lugging this heavy 50-pound sack of rice from shop to shop. You're just desperately hoping to find someone who not only has jeans in your exact size, but also happens to be intensely craving a whole lot of rice. Here's our roadmap for today. First, escaping the barter trap. Then, the magic of money. After that, how banks create money. Followed by why we demand cash. And finally, the modern money supply. Section 1. Escaping the barter trap and the massive headache of finding a trade. The root of this whole headache is a concept called the double coincidence of wants. It basically means finding someone who wants your surplus rice and has exactly the clothes you need is, well, practically impossible. If you aren't incredibly lucky enough to find that diametrically opposite demand, the search costs, meaning the literal physical time and energy you spend just looking for a trading partner, become totally prohibitive, especially as a society grows larger and more complex. And this right here perfectly illustrates the massive leap forward from a barter economy to a monetary system. With barter, your wealth is perishable. Rice rots, It requires massive storage barns. You certainly can't save it up for retirement. But in a monetary economy, your search costs are incredibly low. You just sell your rice for money. That money is highly durable. It requires virtually zero storage space, and it's universally acceptable at any point in the future. It's a real game changer. Moving on to Section 2, the magic of money, the ultimate intermediate good. So money steps in as this ultimate technological fix, and it serves three absolutely vital functions. First off, it's a medium of exchange. It's universally accepted, so you don't have to carry your crops around town anymore. Second, it's a super convenient unit of account. It standardizes relative prices. Like if a pencil is 2 rupees and a pen is 10 rupees, we immediately know a pen is worth exactly 5 pencils. Simple, right? And third, it's a reliable store of value. It allows us to securely hold on to our purchasing power for the future, provided, of course, the price level remains relatively stable.
Okay, Section 3. How banks create money and the Goldsmith's magic trick.
Now, commercial banks interact directly with the public. They accept deposits from people who want to store their money safely, and then they turn around and lend out those funds to people who want to borrow. The bank pays you a lower interest rate on your deposit than the rate they charge the borrower. That difference, which we call the spread, well, that's how the bank makes its profit. But beyond simply making a profit, their true, almost secretive macroeconomic power is actually money creation itself. To understand this, let's think about Lala the goldsmith from our textbook. Originally, Lala just kept his village's gold safe in his vault and gave people paper receipts for it. Eventually, people realized it was way easier to just trade the paper receipts than go get the heavy gold every time. The paper literally became money. Then, Lala realized this clever little loophole. Not everyone comes to claim their gold at the exact same time. So when someone asked for a loan, Lala just wrote out more paper receipts. He essentially invented modern fractional reserve banking right there with a magic trick, creating new money that circulated in the village, backed by only a fraction of the actual gold sitting in his vault. And here's how Lala's trick works mathematically in a modern commercial bank, to drive what we call the money multiplier process. Let's say a bank gets an initial deposit of 100 rupees. Now, the central bank requires them to keep, say, 20% in reserve. So they hold on to 20 rupees and loan out the other 80. That 80 rupees gets spent, and eventually it's deposited back into a bank. Now the bank keeps 20% of that 80, which is 16, and loans out the remaining 64. Fast forward through a bunch of these rounds, and that initial 100 rupees transforms into 500 rupees of total deposits in the economy. Money is literally multiplied, simply because banks know we aren't all going to demand our cash at the exact same time. Which brings us to Section 4, why we demand cash and the velocity of circulation. So you might be wondering, if banks multiply our deposits and actually pay us interest, why hold cash at all? Well, part of the answer is right here, the velocity of circulation. Imagine a tiny two-person economy, just an employer and a worker. The employer pays the worker 100 rupee salary. Over the course of the month, the worker spends that exact same 100 rupees buying goods back from the employer's business. Think about that. 200 rupees worth of transactions happened, but they only needed a single 100 rupee note to pull it off. In this case, the velocity is 2. We demand money based on our daily transaction volume and how rapidly that physical note changes hands. However, our demand for money isn't just about daily transactions. It's also speculative. If interest rates in the economy fall so low that they hit rock bottom, like an absolute minimum floor, we enter what's known as liquidity trap. At this point, people realize interest rates can literally only go up in the future. And if interest rates rise, the price of existing bonds will drop, causing a capital loss. So instead of investing in bonds or keeping money in the bank, earning practically zero interest, everyone panics. They just start hoarding cash. In this situation, the speculative demand for money basically becomes infinite. Finally, let's look at Section 5, the modern money supply, and who pulls the strings. Ultimately, a 100 rupee note, a dollar bill, a euro, it's essentially just a piece of paper. Even the metal in a coin is barely worth anything. This is what we call fiat money. It has absolutely zero intrinsic value, unlike, say, an old gold coin. Now, it is legal tender, meaning it can't be legally refused for settling a transaction, but it derives its worth entirely from trust, specifically the ironclad guarantee provided by the issuing authority, the government. In India, the ultimate architect pulling the strings of the economy is the Reserve Bank of India, our central bank. Established back in 1935, the RBI is the one that issues the physical currency notes, what we call the high-powered money. They strictly control that money multiplier trick we looked at earlier by tweaking reserve requirements and bank interest rates. On top of that, they act as the banker to the government itself. They manage foreign exchange, and they dictate the exact limits of credit creation for every single commercial bank in the country. Since fiat money has absolutely no intrinsic value, and since commercial banks literally multiply and decreate the vast majority of our credit out of sheer trust that we won't all hit the ATM on the same day, I want to leave you with this final fundamental thought from the chapter. Does the cash in your pocket actually exist as a physical reality? Or is our entire modern economy just one beautifully coordinated, universally shared promise? Think about that the next time you buy a cup of coffee. Thanks for joining me on this explainer. Keep learning and keep questioning the mechanics of the world around you.